The market is up. The market is down. You hear these phrases literally every day, right? But they all point back to one single central place, the stock exchange. So today, we're going to pull back the curtain on this engine of the financial world and really see how it works.
So let me ask you, what is the stock market? Really? Is it a physical building with a bunch of people shouting at each other? Is it just some massive computer server humming away in a dark room? Well, the answer is kinda both. And we're about to break down exactly what's going on behind the scenes.
At its heart, the whole concept is actually way simpler than you might think. Just forget all the complicated charts and the jargon for a second, and think about something much more down to earth. Trust me, this one analogy is gonna make it all click.
Okay, I want you to picture a huge, bustling farmer's market. But instead of buying apples and carrots, you're buying tiny little slices of ownership, what we call shares, in giant companies like Apple. A stock exchange is just that, a giant, organized, and regulated marketplace. It's the town square where ownership of companies is bought and sold every single second. So why do we even need these giant marketplaces? I mean, what's the point? Well, it turns out they exist to solve two really big problems at the exact same time, one for the companies and one for investors like you and me.
First, you've got the primary market. Think of this as the company's grand opening. It's where a company goes public for the first time, selling its brand new shares to raise a ton of cash to grow their business. But then you have the secondary market. This is where all the day-to-day action happens. It's our playground, where investors trade those shares with each other. The company's already got its money, now the exchange is just the arena for everyone else.
You know, the absolute best way to see how this all works is to just follow a single share of stock on its journey, from the moment it's born to the moment it lands in someone's portfolio. So let's make this real. So let's invent a company. We'll call it Cool Gadgets, Inc., CGI for short. Let's imagine they make these incredible smartwatches. But to get to that next level, to really explode, they need a serious injection of cash. So CGI decides to go public. They hold an IPO, that's an initial public offering. The stock exchange helps them sell 10 million brand new shares to the public for the very first time, pricing them at $10 a share. This is their one big fundraising moment. $100 million. Just like that. Boom. CGI now has the cash it needs to build that new factory. That's the magic of the primary market. The exchange allowed CGI to fund its dream by selling off tiny pieces of itself to thousands of different people. Okay, now here's where you come in. Let's say you hear about CGI. You love their smartwatches, and you think, hey, this company's going places. So you log into your brokerage app and you place an order to buy 100 shares. The stock exchange acts like this super fast electronic matchmaker, instantly finding someone out there who wants to sell their 100 shares and connecting your orders together. Then, bam, a massive tech website gives CGI's new watch a glowing review. All of a sudden, everybody wants in. With way more buyers than sellers, the share price starts to climb. It goes from $10 to $12. This isn't random, it's pure supply and demand, and the exchange is updating that price in real time.
So you see that price jump, and you decide, you know what, it's time to cash in. You place your sell order, and instantly the exchange finds a new buyer who's willing to pay that $12 price. The trade is done. That ability to buy or sell whenever you want, that's called liquidity, and it is one of the most important jobs an exchange has. And there you go, $200. That's your profit. You bought at 10, you sold at 12, and the exchange handled the entire process seamlessly. It connected the company to its funding, and it connected you to your profit.
All right, so our fictional company, CGI, did its job. Now let's meet the real-world heavyweights, the two major exchanges in the US that you hear about all the time. So you've really got two main players. On one side, you have the New York Stock Exchange, the NYSE. People call it the Big Board. It's the classic, old-school institution, home to older, massive, blue-chip companies. We're talking reliable giants like Coca-Cola. Then you have the NASDAQ. This was the world's first all-electronic exchange. It's the modern digital marketplace, and it's the natural home for the tech titans, Apple, Amazon, Microsoft, you name it.
So how does all of this, the buying, the selling, the price changes, connect back to what we hear on the nightly news? Let's put that final piece of the puzzle into place.
Every news broadcast seems to lead with it, right? The market was up today. Now that we know what the exchange actually is, what does that statement really mean? Well, when they say the market, they're almost always talking about a market index, something like the S&P 500. An index is basically just a scorecard. It tracks a big group of top stocks to give us a quick snapshot of the market's overall health. So if the average price of all those stocks went up, the news reports the market is up. It's just a simple summary of everything that happened on the exchanges that day.
So now you get it. You know how the engine works. The marketplace, the buyers, the sellers, the whole process. But that leaves one huge question. What's the fuel? What forces, everything from global news to a single tweet, are actually pushing the prices of all those shares up or down? That, right there, is the mystery that drives everything.